Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, and today I have a question for you. Have you ever um, invested in an investment and didn't know what to put to put it in a cash investment or to put it in your self-directed IRA? If that is you, if you've ever had that question, where does this investment go? How can I use this investment to create predictable tax-free income? This is what we are going to be tackling in today's webinar, the smart way to grow your self-directed IRA. More specifically, how can we use debt funds to create predictable tax-free income? Now, we do this masterclass live every Tuesday to help you learn the ins and outs of passive investing, to help you turn your active income into passive income and long-term wealth. Now, here's the reality check as we tackle today's question. Many investors actually prioritize equity investment, but ultimately, what they're seeking their portfolio to actually kick off is tax advantage income for retirement. Okay. So, un but putting these equity deals, unpredictable deals in your IRA, they actually, aren't always what it's cracked up to be. We'll be talking next week about our three different income buckets. How do we create the blueprint to put each one of these deals in each one of these buckets? But I just want you to know this is the prequel to next week's webinar because today we got to talk about if you do you actually want to be that tax optimized, and if you actually are trying to create predictable income. I want to show you how to do that. Now, we are talking more specifically today about debt funds. Okay, we've talked quite often, how do we underwrite debt funds? We'll get into that a little bit, but we're also going to take it with the lens on what does it mean to have a debt fund in a self-directed IRA? Why is that super powerful as we set up the conversation for next week webinar? Well, we've talked, in the past videos about how right now in this volatile market environment, equity investments still are a little bit challenging. I mean, are we buying at the bottom of the market? Are we buying, are we in areas of the United States where we're buying, still in the hyper supply and things haven't quite bottomed out? Where are we here? And if we're getting into an equity investment and expecting it to kick off predictable income, that may not always be the case either. Now, we are seeing interest rates start steadily ticking down. The hypothesis for the end of 2025 going into 2026, we'll see a couple more rate cuts. But we still haven't seen the full reset to actually clue us in if this is the right time to jump back into equity. So, what's performing right now in today's market despite the higher interest rates? Now, as always, cash drag in our portfolio is something that no investor wants. And we have to kind of, understand where is a safe place to put our cash. One, in order to generate a return, to keep from losing from inflation, but two, to make sure we maintain our liquidity as the market continues to correct. And debt bridges is one of those things that it deserves the seat at the table because it bridges right now in this market environment, going from equity investing or getting prepared to get back into equities. Now, we have to make sure we are investing in debt the right way, so we will recap that information. Now, if this is the first time you and I are meeting, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com. And this is what I love doing is teaching people how to invest in passive real estate, be it on the equity side or the debt side. But I come at it from the lens is I've actually walked the talk. I started investing in 2002 very actively in single family rentals, live-in flipping, house hacking, bought the multifamily buildings, even raised capital into multifamily general partnerships. But what actually broke the financial golden handcuffs for me was my passive portfolio, the part that didn't require my time, and I could leverage other people's expertise. And that's what I love showing people here how to do is how can you get 100% control and choice on how you spend your time? And I chronicle this whole journey in my book Money for Tomorrow, which you can pick up on Bigger Pockets or Amazon.com. So this is my intro to you. If you want to connect with me, if you want to learn more, if you want me to get eyes on your portfolio, join me at passiveinvestingwithwhitney.com. There we can jump on a one-on-one call, access vetted deals, and connect you to additional resources for your education. All right, so we are going to be talking a little bit about how do we think through putting debt funds in a self-directed IRA? What are the pros? What are the cons? Now, that's not financial advice. Everything is educational only. So, not financial advice, legal advice, tax advice. Make sure to consult your team before jumping into any decision. Now, we've already talked about why we need to consider uh, what we put in our self-directed IRAs, okay? And a lot of investors, maybe you, I've done this myself, have opened as self-directed retirement accounts. Maybe it's a self-directed Roth, self-directed traditional account, or a solo 401k even, and to put an equity deal in there. But we probably had the lens that we were doing it to get the cash flow growth as well as the equity growth. And how do we take advantage of the tax benefits? But right now in this market, we've kind of have the stalled equity, investment piece. So where can we turn to mimic the cash flow, allow it to compound to get the equity growth, and keep this investment tax advantaged? All right, so we've talked about the opportunity cost, okay? And really, the opportunity cost, is that you can take the same cash, say you have $100,000 sitting in cash, and you can add 50K to it every year. You can take that and keep it on the sidelines in a high yield savings account. All right. Right now, it's earning about 4% interest. You can put it there, and over the course of 10 years, you'll come away with about $739,000. You can take the same money and put it in stocks, bonds, and mutual funds, allow it grow for 10 years. Okay. And we're talking about a standard 60-40 portfolio and probably walk away on average with about $960,000. Now, both of those, there's obviously a huge jump between stocks, bonds, and mutual funds and money market accounts, but we're taking on more volatility to go into public equities and bonds. Where can we go with this money? Because this money is in our self-directed IRA, right? It is money that we are relying on for retirement. Now, whether you're going to draw down on the capital that's in that retirement account, or if you want to flip it to cash flow, how can we reliably build that account? And this is where a tiered debt fund opportunity matches incredibly well for a self-directed IRA account. Okay, we can actually take the same money, the $100,000, and if we can contribute 50K into those accounts, now, we would have to partner with a custodian to see if we can put that through a solo 401k or if we're contributing across our Roth IRA together to hit that 50K contribution. But let's just take the tax advantage piece. We've got the tiered debt funds in there. You're earning 8 to 10% interest across those debt funds. Now you got $1.1 million, possibly more, in those retirement accounts that we can flip the switch and turn it to cash flow without the volatility that equities produces in our portfolio. And we didn't even model out, a private syndication. Why is there this gap, this $274,000 gap between the public equities and a tier debt using tiered debt funds in a retirement portfolio? Well, it's because every dollar you invest, if you're in the right fund, in a properly structured fund, every dollar you invest, you're going to get rewarded when you flip different tiers. Okay. So in the case of our, pick real estate debt fund, you start off at 6% for $25,000 investment. When you hit $100,000, you're going to get 8%. When you hit $500,000, now you're going to get 9%. When you hit $1 million, now you're earning 10%. You don't do that. You don't get that type of reward in the stock market. What do you get? increased fees based on how much you're investing. All right. So that's a huge advantage. We can put these things into our self-directed IRA account and keep that largely tax advantaged for ourselves. Now, I do want to kind of jump backwards because somebody here might be going, Whitney, I don't understand what a debt fund is. What is a debt fund? Why is it so powerful? And why, oh, why do I want the debt fund in my retirement accounts as opposed to holding it in cash? Now, there's no right or wrong answer on whether you hold it in your retirement account or in cash. We're just going to draw the case for holding it in your retirement account today. So a debt fund, it's a real estate instrument, okay? It's a real estate debt fund lends money to real estate operators on their projects, be it residential projects, commercial projects, and it's a loan. So it's actually secured by the property itself. If the borrower does not perform, the lender, which is the fund, and you're one of the lenders in the fund, gets to take back that property, and the fund gets to reposition it and reap the benefits of that reposition. So you earn interest income. You're in primary, priority payment in case of default or deficiency. There's no equity or ownership complications, no property management headaches, and oh, did I mention you don't have to deal with tenants, toilets, trash, or termites? Okay. Now, the properly structured debt fund can provide this predictable income, but remember, we don't all, I'm not suggesting we only invest in a debt fund. A debt fund is part of a three-tiered investment strategy. Okay, think of it like a stool. If we cut off one leg of the stool falls over. Okay, so we want to make sure that yes, we do have our growth opportunities. Maybe you're like me, you did a heavy amount of equity investing in the past few years. And now you need to inject that cash flow layer into your portfolio, create some diversification. Okay, that's our leg number two is the income layer. Investments that may or may not be tax advantaged themselves. Maybe they're not throwing off depreciation, but they are predictable, regular income. And oh, by the way, they have short timeline horizons, meaning we can get in and out of that fund pretty readily. Also, the third leg of the stool is making sure as an investor that we maintain that liquidity. Okay. Now, our first layer of liquidity is going to be emergency funds and reserves. All right. We talk about that quite a bit, but also maintaining liquidity and access to capital for opportunities. Okay. Personal needs. So the debt fund helps us do that. And when we put a debt fund in a tax advantage account, we can actually create some compounding within that account while keeping it tax advantage. All right. So this is where debt funds and IRAs, they can either go into a tax deferred IRA vehicle or a tax free IRA vehicle. That is how we keep the income from the debt fund from being subject to ordinary income. Okay, now that is just one part of this plan. Okay, we still have to make sure it's a good debt fund, but that is the keys to putting that debt fund. If we could, have our different buckets, what bucket would we put it in? Okay, all things created equal, right? If you don't care about the cash flow today and you just need the cash flow tomorrow, if you've got a choice between holding the debt fund in cash or holding it in your IRA account, it could be a really good opportunity to put it in your IRA account. Now, next week, we're going to go down the rabbit hole even more on what investments from a tax optimization standpoint fit best in which of those buckets. But for the purpose of today, matching the debt fund into a tax advantage bucket can be a very, very powerful strategy. Okay, but not just any debt fund. We want to make sure it's in a debt fund that's going to help us preserve our capital. All right. It needs to produce predictable returns. Okay. And we need to have an opportunity to continue to reinvest in the debt fund, not in large chunks like 25, 50K, 100K, but even smaller. How can you continue to add in smaller chunks like 1,000K to keep your cash flow earning and compounding quickly? Right? Now, I know for me, when I have cash building up in my self-directed IRA account, it's a little hard to get it build up in 50 and 100K chunks pretty fast. But I can get thousands of dollars, $1,000, $3,000, $5,000 building pretty quickly. We want to have an opportunity to keep that cash moving. All right. So just a quick recap is again, not all debt funds are created equal. We don't want to just put any debt fund in our self-directed IRA account. Okay. We want to make sure that we're holding on to our underwriting rules when we put a self-directed debt fund in our self-directed IRA account. Why? It's because we are using money that we set aside for our future self. So it better well darn still be there. Okay. So this is where we have to really embody the capital stack. Are we investing in positions that are low risk? Okay. And maybe not low return. We'll show you how to juice that return a little bit by using a self-directed IRA account. All right. So I like putting these things in my retirement account because I can allow it to grow and compound faster and know that it's going to be there for me later on. But we don't just want to go into any first lien position. Just because the debt fund says it's first lien, we still need to abide by some of the rules, which is we need to make sure that not only is it in a good position in the capital stack, right? If we're going to invest in a debt fund and put that in our self-directed IRA account, that it's we are in priority payment. It is actually secured by a hard asset like residential real estate, commercial real estate, maybe even land. Now, remember, all of those things have their different risk profiles to them. Okay. This is where it's a little bit challenging. I see people put very volatile debt fund investments in their IRA account, and I'm not sure I would agree with that position. We also want to make sure when we're looking at the debt fund that goes in our IRA account, that you understand where is that asset in its stabilization. Okay. Is it a stabilized asset? Is it distressed? Is it, ground up development? Okay. Riskier assets might be best held in cash. And we'll talk about that why next week in our part two. Then also the legal structure. Okay. So cool thing about self-directed IRA accounts is that we can write individual notes through them. We can invest in a debt fund, okay, which is my personal favorite. We can probably even connect to a crowdfunding or a JV platform. All right. But remember, each one of those structures is going to have different variability on liquidity, fees, and control. Debt fund generally offers the best fee structure as well as the best liquidity when all things are considered. Okay, underwriting a debt fund, that still doesn't change. Even though it goes in our IRA account, I would even argue that you need to be even stricter in your underwriting. Why is that? Is because we want to make sure that money is not being gambled away. If we lose that investment in our IRA account, depending on how your affairs are organized, you may not be able to take that loss and write it off. Okay, so investments that go in our self-directed IRA account need to be, I don't want to necessarily promote conservative, but that's the lens that I take on it. I want to make sure that I'm hitting base hits with those investments in my IRA account, and I'm letting time help me out as much as possible. So we still are going to operate by our 3Ps framework: people, processes, and protection. Okay, we want to make sure that we're asking the right questions in each one of these categories. We want to work with operators and lenders. Remember, we're underwriting two operators here: the lender, the person raising the funds, and the person deploying the funds. We want to make sure we're working with a very seasoned team, that we're clearly aligned with each other, that they have amazing processes in their document underwriting, independent property evaluations, that they're tracking their borrowers, all right, and that you have a lot of protections in place. Why? This is future money for our future selves. Okay, we want to make sure that that investment is sound and secure as we can realistically uncover for ourselves, checking all those boxes. Nothing's ever 100% guaranteed, but we want to make sure that we aren't taking unnecessarily risks with our retirement account. And we've got our 8 additional due diligence questions that you want to add to your underwriting for any investment, really, but particularly debt funds in your portfolio. The loan structure, how are the loans diversified? What's borrower screening? Okay, what are the liquidity terms? How is it performed under stress? With COVID, rising interest rates, heck, even going back to 2008, does the team have experience in the great financial crisis? Does the fund use internal leverage? Okay, and what is the reserve policy? So, for those of you who have not seen our previous webinars on how to underwrite a debt fund, regardless if you hold it in cash or a self-directed IRA, here is a cool snapshot of comparing 2 debt funds in today's environment. One of them being ours, and another popular one that we quite often, run across that our investors either have or are looking at. Now, debt funds come in all shapes and sizes, like we saw, right? They come with different capital structures, different risk profiles. But again, if we're putting this in our self-directed IRA account, again, the whole point of that is to make sure that money that we earned and we set aside tax deferred or tax free in a Roth remains there. We want it to still be there. Okay. So this is where like I said, I even get a little bit more conservative. This is where I notch down my risk a little bit and make sure that I'm going into only deals that are in first lien position. Nothing mixed. I like residential real estate. Everybody needs a roof over their head. Okay. Um, Fix and flip. Okay. That's a good development phrase. For me, I understand it. I've done over 40 of those type of loans myself. I understand the type of borrower that they're working with. But more importantly, the loan diversification of the portfolio. I want to even make sure that that fund's even more diversified. This is where, looking at a fund where there's, a little bit of risk with just fewer borrowers, fewer markets, or fewer deals in the fund can be a little bit more risky to me. So I want to make sure that I'm well diversified in that fund. Now, distribution-wise, this is interesting. Okay, I love in a self-directed IRA account, I love putting in debt funds that allow for monthly cash flow. But remember, this is money I probably don't need right now. So, and maybe you don't need it right now either. So you get to allow it to compound and grow even faster. Okay, this is where we can actually mimic an equity-like return without taking the equity risk of putting that asset in our retirement portfolio. And when we're ready to start drawing on the income, we can simply contact the operating team and say, hey, instead of compounding, can I move it to monthly income? That is something we can actually pay our bills with in retirement. And then everything else holds true. We want to be in funds with low default rates, low deficiency, low lockup periods, okay, low to no leverage, right? All that remains true in our underwriting. Okay. All of our risk is going to boil down, with any debt fund, whether we hold it cash or in an IRA account, weak underwriting, excessive loan to value, no borrower limits. Those are the things, no recovery plan, poor monitoring of the borrower. Those are the big landmines that are going to, make that fund really risky outside of those check boxes for our due diligence. All right, so today we were discussing debt fund in a self-directed IRA. Does the PIC real estate debt fund still work in a retirement vehicle? And the answer is yes. Why? Because we are investing in our future self. We want to make sure that capital is there and that we have the ability to create cash flow with that capital so we don't have to deplete our equity, our capital in that in our retirement account in order to, when we withdraw on it, we don't have to withdraw down the retirement account. So we've got first lien position, built-in diversification. All of our borrowers, or excuse me, all of our investors are in true preferred return. You've got the flexibility in distributions and the flexibility in the liquidity in the PIC real estate debt fund. Now, if you're interested in learning more, I encourage you to reach out to me at passiveinvestingwithwhitney.com. There, we can go over specifically the details of the PIC Real Estate Debt Fund, where we're invested, what our track record is, and all how this lines up with what you might be seeing in the environment, other deals that you're looking at. But I want to draw your eye to one more thing. This is the biggest pushback I get from investors who have self-directed IRA accounts. They're like, hey, I actually opened up this account so I could continue to put real estate assets in this account. Well, that how is that working for you as far as cash flow and equity growth, right? If in this type of market, it might be a little compressed. You know, rewind 5 years ago, fast forward 5 years from now, that might be a different story. But where can we kind of get very steady, easy, just play the math game, right? Allow time to work for us. And the power of compounding that you can get through a debt fund investment can be incredibly powerful. We can get an equity-like return by putting this debt fund investment in our retirement account, okay, without taking the unnecessary risk. All right, if you want to learn more, if you want to understand the different return tiers, how this could apply to you and your situation, make sure to reach out to me at whitney@passiveinvesting.com. That's my email address, or schedule that time at passiveinvestingwithwhitney.com. Now, if you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show.